Hi everyone, in today's video we are going to study Consolidation chapter 3, that is Goodwill. In previous video we have completed chapter 2, important consolidation calculation. Now, objective to describe the measurement and recognition of goodwill and non-controlling interest. IFRS 3 business combination, definition, acquisition method and goodwill. Under goodwill we have under this we have consideration, identifiable asset and liabilities, accounting for goodwill. Under this we have impairment of goodwill. So in this chapter we are going to study mostly which we have already studied in previous chapter, that is numerical calculation, but in this chapter we are going to study that numerical calculation in theoretical way. Definition of a business. A business combination arises when an acquirer obtains control of a business as explained in chapter 1. We have studied this in chapter 1. A business is an acquired set of activities and assets that include as a minimum an input and a substantive process that together significantly contribute to the ability to create output. So we have input, process, output. We have studied this in chapter 1. Acquisition method. At the acquisition date, IFRS 3 required that the acquisition method is applied to a business combination. As the date of the acquisition, the acquirer should identify the acquirer. One entity must be the acquirer. Determine the acquisition date, the date on which control is obtained. This is important. What will be the acquisition date? The date on which control is obtained. Recognize and measure the identifiable asset, acquired liabilities, assume and non-controlling interest in the acquiree. Recognize and measure goodwill or gain on bargain purchase. First working, what we do, we identify the acquirer. What is the percentage of equity we purchase in the acquiree? Second is identify the acquisition date. On the acquisition date, what we do, we just combine the line by line of item assets and liabilities, and we get the fair value of net assets. Assets minus liabilities equal net asset. Recognize and measure goodwill or a gain on bargain purchase, as we calculate goodwill uh, in working 3. So that's what they are saying. Identify the acquirer. The acquirer is the entity that obtained control of another entity in accordance with IFRS 10 consolidated financial statement, what we have studied in chapter 1. And investor control an investee where it has power over the investee, exposed or right to variable return from its involvement with the investee, the ability to use its power over the investee to affect the amount of the investor's return. Where a business combination primarily involves an exchange of equity interest, the acquirer is usually the entity that issue its equity interest. So the here we have the meaning of control. What is the control? Power over the investee, exposure or right to variable return from its involvement with the investee, the ability to use those power over the investee to effect amount of investor return. Where a business combination primarily involves an exchange of equity interest, the acquirer is usually the entity that issue the equity interest. Now, goodwill. Definition: an asset represents the future economic benefit arising from other assets acquired in a business combination that are not individually identified and separately recognized. Now, calculation. Goodwill is calculated as difference between the cost of acquisition, consideration transferred, plus non-controlling interest and fair value of acquired fair value of acquiree's identifiable asset and liability at the date of exchange. So net asset we consider here the same meaning. We have already seen that in working in working 3 how to calculate goodwill value. The same thing here in the theoretical form. Basic principle: IFRS 3 requires that purchase consideration is measured at its fair value. This is the amount of cash or cash equivalent paid and the fair value of any other purchase consideration given. Deferred consideration: if cash is to be paid sometime in future, the amount will need to be discounted to present value, and that amount included as the fair value in the cost calculation. So discount value is given, we need to calculate the current value by using that discount percentage. The increase in present value through the passage of time will be an interest expense presented in the finance category in profit or loss. So the increase in present value, what will be the increase in present value through the passage of time? We need to add it in the interest expense presented in the financing category in P&L, as we have IFRS 18 new format of P&L. Contingent consideration, extra payment the buyer might have to make later depending on future event. Example, earn out right to future profit. How it will be settled matters. If it will be settled in cash or other asset, recognize a liability at acquisition date measured at fair value. If it will be settled by using share, then recognize it in equity at acquisition date measured at the fair value. Any disclosed contingent liability should be disclosed. So if we have any disclosed contingent liability, we need to disclose it. Now, issue of share. It is quite common for a parent to acquire share in the subsidiary by issuing its own share to the previous shareholders in the share exchange. The cost of acquisition is cost of share at acquisition equal number of share issued multiplied by market price of parent share at the date of acquisition. So we need to take the price at the date of acquisition. This is important point. Number of shares we are going to issue multiply by market price of parent share at date of acquisition. We can understand this by this example. Parent acquired 80% of subsidiary 100,000 share in 345 exchange. 345 exchange means parent will give their 3 share and parent will take their subsidiaries 5 share. So this is the meaning of 345. The market price of one share in P on acquisition was 4 and that of S was, so parent is 4 and that of S was 2.2. So subsidiary was 2.2. Determine the amount of consideration for the investee. Cost of investment, we have 100,000 multiplied by 80% multiplied by 3 divided by 5 into 4. So the amount we got 192. Simple. First we need to consider that total share value multiply by percentage, how many percentage share we have acquired, multiply by parent, the shares which parent are going to issue, and divided by the shares which parent took. Exchange here 345. So 3 divided by 5 multiply by the parent value. The market value of subsidiaries share is irrelevant. Now, takeover of share-based payment. When acquirer agree to replace an existing share-based payment award that has already been issued to the employee of an acquiree, the fair value of replacement share award to the relates to the pre-acquisition period form part of the consideration paid to the seller, and so is included in the goodwill calculation. Means that when acquirer agree to replace an existing share-based payment award that has already been issued to the employee of an acquiree. We have share-based payment as per IFRS 2. So the fair value of the replacement share award that relates to the pre-acquisition period. So we have always two, pre-acquisition period and post-acquisition period. Okay. From part of the consideration paid to the seller that will be included in the goodwill. For example, we have share-based payment and vesting period is 3 years. After 1 year, company is get acquired. So for the parent here in this scenario, pre-acquisition period. So pre-acquisition period is 1 year because and post-acquisition period is 2 years because parent acquired subsidiary after 1 year and vesting period of share-based payment is 3 years. So first year is already gone, so that will be pre-acquisition, and post-acquisition they have still remain 2 years. The fair value of relates to the post-acquisition period is recognized as staff cost as required by IFRS 2 share-based payment. Now calculate goodwill on the acquisition of this olive company. Solution, we have cash consideration, the amount we paid 29,000 and replacement share options. So here amount is 1100. I'll show you how 1100 came. Net asset we acquired 26,000 and the goodwill amount is 4,100. Now, any employee option will be remeasured at fair value of the acquisition date multiplied by remaining years divided by total years. This is a formula. Okay. Now we will understand this how 1100 came by looking at this data. The fair value of the original share option at acquisition date was 2.2 million. So here share option at the acquisition date, that value is 2.2. Vesting period is 4 years. Original and replacement scheme. The pre-acquisition period is 2 years and the post-acquisition period is 2 years. Consideration for the acquisition is therefore 2 divided by 2 multiplied by 2.2 equal 1.1 million. We will see that. Now, the fair value of replacement option at the acquisition date is 3 million. Here, the replacement option we have 3 million. Here, original share option at the acquisition date was 2.2 million. So both are different. Okay. Now we will see that how it came. Any employee option will be remeasured at fair value of the acquisition date. Okay. Multiply by remaining years divided by total years. And any employee option will be measured at fair value of the acquisition date. So the fair value of the acquisition date of employee option, what is the value? Of employee option, we have 2.2. Okay. We need to check the employee option, not replacement option. That is different and employee option is different. 2.2 multiply by remaining years. We have remaining years, that is 2. Divided by, we have total years, that is 4. Okay. Equal 1.1. That's how it came. Now we will understand what is a replacement share option. This one 3 million value. Note, the fair value of the replacement option at acquisition date is 3 million. So we have 3 million fair value of replacement option at acquisition date. Therefore, 1.9 million we need, this will be a staff cost. How? 3 million we have that, now we have formula for the staff cost. What is the formula? Fair value of replacement option minus portion treated as consideration. So the fair value of replacement option is 3 million. Here replacement option. Here this one employee option, stock option, we have share options. This is different and replacement option is different. Okay. And minus portion treated as consideration. So how many portion? So the what is the portion we treated as consideration? That is 1100, 1.1. Now 3 million minus 1.1 will be 1.9 million. That will be staff cost, and this will be allocated over the years, over the post acquisition period. IFRS 2 require the fair value of equity settled awards to be recognized as an employee expense over the vesting period. The total fair value is therefore spread over 2 years, 28-29. This is post acquisition, with 1 year charge recognized in 2028 and second year charge recognized in 2029. Now we can see the example journal entry. If it is cash settled, then DR employee expense, it will goes to P&L because expense, and CR share based payment liability. If it is equity settled, then journal entry will be DR employee expense, again P&L, and CR will be that equity amount, share based payment reserve. Now the transaction cost. IFRS 3 require the transaction cost, example legal fee, advisory cost, or valuation fee incurred on the acquisition of subsidiary are expense in the period they are incurred. So all these transaction cost will be expense at that period when it is incurred. Acquisition cost do not form part of fair value of consideration transferred and not included in the goodwill calculation. So the acquisition cost is not part of fair value consideration. It will be expense. Costs related to the issue of share or debt are treated in accordance with IAS 32 financial instrument presentation or IFRS 9 financial instrument. Once we are going to study these standards, we will see the treatment. This will generally mean that they are recognized within equity. So we have recognized all this within equity. We will see that, no problem. Contingent liability of the acquiring. IAS 37 provision, contingent liability and contingent asset does not allow contingent liability to be recognized in the financial statement of single entity. So the provision of contingent liability and contingent asset not recorded in the financial statement of single entity. However, if contingent liability of the subsidiary has arisen due to present obligation. First important point, contingent liability of subsidiary has arisen due to present obligation that has not been recognized because of an outflow of economic benefit is not probable. So we didn't recognize because outflow of economic benefit is not probable. So IFRS 3 is requires that to record this as provision as long as fair value can measure reliably. IFRS 3 requires this present obligation to be recognized as provision as long as fair value can measure reliably. The provision is recognized on the business combination only and therefore appears only in the consolidated statement of financial position. Now, examine advice if question states that a subsidiary has contingent liability on acquisition. Recognize it as a provision in the consolidated account. IFRS 3 and the conceptual framework. Example, internally generated and intangibles and contingent liabilities. If fair value is measured, then we will recognize. If not measured, then not recognize. Measurement. All assets and liabilities of the subsidiary which are recognized in the consolidated statement of financial position are measured at their acquisition date fair value with limited exception. IFRS 3 requires certain assets and liabilities to be measured in accordance with their relevant standards, such as deferred tax, employee benefit, share-based payment transaction, and non-current asset held for sale. So we will apply separate standards for this. Provisional accounting estimate when a parent buys a subsidiary, some asset or liability amounts may be provisional because they can't be measured exactly at the acquisition date. The measurement period maximum 1 year from the acquisition date. So the measurement period we have maximum 1 year from the date of acquisition is the time during which parent can update those provisional account when it obtain new information about fact and to the circumstances that exist at the acquisition date, and those updates are made retrospectively. That is, the original acquisition accounting is adjusted as if the correct amount had been used for day one. After the 1 year measurement period ends, you cannot keep changing the acquisition accounting just because you later earn a different number. The one exemption is if you discover an actual error, for example, mistake in calculation or misuse of accounting policy. Errors are fixed under IAS 8, corrected retrospectively with disclosures. Note after 1 year we cannot change retrospectively. Example question. On 1st October 2021, PECO acquired 100% interest in Espartan. When PECO issued its 31st December 2021 financial statement, the valuation of acquired trademark was incomplete. PECO estimate 1 million as the provisional fair value of trademark and 5 years life. On 30th April, the valuation of the trademark was finalized. The fair value of acquisition date amounted to 1.2 million. So what we have here in this, first we have company acquired on 1st of October. Company acquired a subsidiary on 1st of October, and that time the fair value of the trademark was incomplete. Okay, the valuation of the trademark was incomplete. So parent used a provisional account. Okay, provisional fair value of the trademark that was 1 million. Okay, but That was 1 million. But now on 30th of April, the valuation of the trademark was finalized. Now the value become 1.2 million. Now, requirement, we have discussed how PECO should reflect the acquired trademark in the consolidation of goodwill and its consolidated financial statement. Whenever we acquire any intangible asset with a finite life, okay, so what we do, we amortize that. Okay, so first, what we need to keep in mind, first we will have amortization of 5 years, because value of this is 5 years. So we will amortize this for 5 years. On 31st of December, what we value we will use to amortize, that is 1 million. Okay, why 1 million value we will use? Because we have provisional fair value. On the basis of provisional value, we will amortize this. So once we got the finalized amount of trademark, we will replace it. How we will replace it? Let's see. First, PECO should initially recognize the trademark in the consolidation of goodwill at the acquisition date at the provisional fair value of 1 million. The amount is also recognized as intangible asset in the consolidated financial statement. So they will also recognize intangible asset in the consolidated financial statement, initially measured at 1 million. Subsequently, the trademark should be amortized over its 5-year useful life, given a carrying amount of 950 million. 950,000. 1 million, 1 divided by 5, 3 divided by 12. So the simple method of solving this is 1 million we have 1 million we have trademark value. First, simple, we will divide it by 5. So per year value we get 200,000. Okay. Now, so per year value we get 200, 200,000 means this will be amortized each year, this value. So 200,000 multiplied by 3, because we have utilized 3 months, October, November, and December. 3 months we have here. 3 divided by 12 equal, we will get 50. If you will do, then the amount will be 50,000. The 50,000 will be subtracted from the 1 million, and the carrying amount of the trademark will become 950,000. So this will be first adjustment. Since the initial measurement is the provisional, IFRS 3 allow that work to finalize fair value takes place during measurement period. This this lasts until the earlier of 12 months after the acquisition date and the date on which required information is obtained. In this case, 30th April 2022, when the finalized acquisition date, fair value of 1.2 million is determined. So the retrospective treatment we need to do. Adjustment are made to accounting for the business combination in the comparative amount for 2021 as follows. Now look at the retrospective treatment, how we are going to do the retrospective treatment. First, the carrying amount of trademark as 31st December 2021 is increased to 1,140,000. Okay. The increase of 190,000. Retrospective, the increase in fair value of 200 less 10,000 additional amortization from the acquisition date to 31st December 2021, 0.2 million, 3 multiplied by 60 months amortization. This is just so confusing. I'll explain you the simple way to calculate this. So increased amount, how much we have? Increased amount we have 200,000. 200,000 increased amount in the fair value. 200,000. We are going to pass the journal entry, and that journal entry will increase the value of trademark by 200,000. So the carrying value at the acquisition will become 1.2 million. Okay. So 200,000 increase divided by 5. So per year we will have how much we will have per year? Wait a minute. 200,000 divided by 5, 40,000. 40,000 per year amortization on that increased value. Okay. So the 40,000 per year amortization we will have. So total amortization here 200,000 plus 40,000, 240,000 amortization per year. So amortization we have already calculated for 3 months on the basis of 1 million carrying value. The amount became 50,000. Now for additional, we just need to make the additional one. The additional 40,000, 40,000 multiplied by 3 divided by 12. This will be 10,000. So the retrospective treatment for the depreciation, the amortization, the amortization will increase by 10,000 at the year end 2021, 31st December 2021, because the carrying value we finalized that increased 200 total value. So the carrying value is increased, so it means that depreciation also, amortization will increase. And now the total carrying value we need to find it. Carrying value at the end of carrying value end of 31st December 2021. The carrying value will be, first we need to take the 1 million amount. Okay, 1 million, then increased amount. Okay, let's go step by step. Then no, let's add this for the because something. Okay, no. 200,000 increased value in the increased value because of valuation. So carrying value will become 1.2 million. Okay. Now the amortization. First amortization we have 50,000. 50,000 on 1 million carrying value. Again we have 10,000 amortization on the carrying value, which increased carrying value, that is 200,000. So the total amount you can calculate will be 1,140,000. Yeah, so everything is same. Yeah, one important point, goodwill is decreased by 200,000. This is very important for a pre-populated sheet. Once the value of this trademark will increase, so it means that how we calculate the goodwill. Goodwill value we calculate by doing consideration paid, plus that value of NCI. Okay, let's just add the NCI. It will be confusing. NCI add NCI less fair value of net net asset acquired equal goodwill. So now, for example, take any value. Now suppose any value. Concentration and fair value, concentration paid. Okay, 2 million. Consideration paid is 2 million. 2 million. Okay. NCI value need to add. NCI is suppose that 500,000. 500,000 NCI. 500. There's fair value of net asset acquired. So the fair value of net asset acquired, we have total 1.5 million. 1.5 million. When the value of this, where it is, yeah, value of the trademark will increase by 200. 200. So it means that we need to add 200 here. So when we will add 200 here, it means goodwill will decrease by 200. That's what they are saying. Goodwill will always decrease when the fair value of net asset will increase. Okay, due to any reason like valuation or a fair value uplift. Any reason, once the fair value of net asset will increase, goodwill will decrease. Simple rule. This all these things I have explained in the simple way. No need to go that much. Okay, fair value in financial statement of subsidiary. We assume share capital is the same at acquisition and reporting date unless the acquisition says it change. Because subsidiary never change its record to fair value. Okay, it continue using historical cost accounting. We will see that once we are going to solve the questions. A bargain purchase is recognized in the consolidated statement of profit or loss in the year of purchase only. Consolidated statement of profit or loss later year are not affected. However, consolidated retained earnings in the consolidated statement of financial position is increased in the year of purchase and in later year until disposal of subsidiary. Impairment testing. Now, impairment testing. For the purpose of impairment testing, goodwill must be allocated to a cash generating unit, CGU, that benefit from acquisition. A CGU need not necessarily be a unit of the subsidiary acquired. It could be unit of the parent or another subsidiary in the group. The unit must be at least that of an operating segment as defined by IFRS 8 operating segments. Now, key point. Each CGU must be tested annually for impairment. The test must be carried out at the same time each year, but does not have to be carried out at the year end. Any impairment loss is classified as an operating segment in the statement of profit or loss. Now, partially owned subsidiary. NCI measured at proportionate share of identifiable net assets. Parent acquired 75% of subsidiary. The carry amount of the subsidiary's net asset on the reporting date was 1800. This includes 300 of goodwill. The NCI was measured using the proportion of net assets method. The recoverable amount calculated to include all assets and liabilities of the subsidiary on that date was 1640. Requirement, we have calculate any impairment loss and discuss how it is recognized. Carrying amount, first we have goodwill plus notional unrecognized goodwill. Now, the important point, how to calculate notional unrecognized goodwill in the case of partial method. Okay, let me show you. Now let me make a simple formula to so that you can solve it easily. Notional. Here we need to mention the value. Mention the value of the goodwill which is given. So one thing always understand, the value 300 of goodwill is given, that all belong to parent only. So this is the parent goodwill value. It means 300 is 75% of total goodwill. 300 divided by 0.75 equal, you will have 400. So it means that 400 was total goodwill, and from the 400, 75%, that is 300, belong to parent. So simple, if you want to calculate for NCI, calculate this NCI goodwill equal notional goodwill minus partial goodwill. Partial goodwill. Same, you will get the NCI. NCI equal national goodwill we have, sorry, 400 minus partial goodwill we have 300. NCI will become 100. That's how we need to calculate it. So the notional goodwill formula I want to make it equal divided by. So the notional goodwill formula will be goodwill value. The amount goodwill value is 300 divided by parent share. You can take a screenshot because I am going to remove it now. The impairment loss is first allocated to goodwill. In this case, the total goodwill of 400 absorbs all of the loss of 260. Okay, now let me show you that how it's gain loss. Goodwill we have 300, that is parent goodwill. Notional unrecognized goodwill means NCI share, that is 100. Other net asset we have 1500. Total carrying value became 1900. So what is the formula of impairment? The formula of impairment is carrying value less recoverable amount. So impairment will be that value. So here in this scenario, carrying value is 1900 and recoverable amount is 1640. So the impairment loss is 260. Recoverable amount is higher of value in use or fair value less cost to sell. The impairment loss is first allocated to goodwill. In this case, the goodwill of 400 absorbs all of the loss of 260. 75%, 195 leads to unrecognized parent goodwill. Now, how it will be calculated? 75% we have parent share, so 195 it will be. How? 260 multiplied by 75, it will be 195. Okay. Then NCI share we have 25% multiplied by 260 equal 65. Okay, only the loss relating to the recognized goodwill is recognized in the profit or loss. So this 75% recognized parent goodwill will be recorded in the ENL. 25% related to unrecognized NCI goodwill will not be recorded. This will be ignored. This is an important point. This reduces the profit allocated to the owners of the parent in the consolidated statement of profit or loss. Now, recognized goodwill is therefore 105. 300 minus 195. 105 will be the recognized goodwill after accounting for the impairment loss. Because impairment loss we have deducted 195. Why not 260? Because 260 include both parent as well as NCI. But in the case of partial goodwill, we don't consider NCI value. We only consider parent goodwill. We don't consider NCI goodwill. That's why. In proportion method, NCI goodwill is hidden, not recorded, but for impairment, we must consider full economic value because for impairment, we consider full value. That's the thing. We need to understand it. We will consider full value, but the rest we got it how much? 260 minus goodwill value was 140. 400, sorry. So 140 will not be there anywhere. Only 105 we will consider it because 140 also include the NCI share of 25%. But here in the partial goodwill method, NCI proportion is ignored. So that's why 105. Now impairment entry, DR retained earning. This is very important for pre-populated sheet because whenever we will have impairment, DR retained earning 195, CR goodwill. So goodwill will decrease and retained earning so goodwill will increase, sorry, and retained earning will decrease. NCI measured at fair value. Parent acquired 90% of subsidiary. The carrying value of the subsidiary net asset on the reporting date. Yeah, one more important point. So when the asset value will decrease, goodwill will increase. When the asset value will increase, goodwill will decrease. This is important point for pre-populated sheet. Keep this in mind. NCI measured at fair value. Parent acquired 90% of subsidiary. The carrying amount of the subsidiary's net asset on the reporting date was 1900, and the carrying amount of goodwill was 500, of which 25% related to NCI. The NCI was measured at fair value. Here it is fair value method. The recoverable amount calculated to include all assets and liabilities of the subsidiary on the date was 2200. Now the carrying amount, always consider this. Where is, wait a minute, net asset plus goodwill. Yes. So the carrying value will be 2400. Recoverable amount will be 2200. So there is impairment because carrying value is more than recoverable amount. If recoverable amount is more than carrying amount, then there is no impairment. Impairment loss is 200 in this scenario. The impairment loss is first allocated to goodwill. In this case, the total goodwill of 500 absorbs all the 200 loss. Okay. First, it will allocate the goodwill. If goodwill is fully allocated, then we are going to allocate on the CGUs like this. The 200 loss is recognized in profit or loss and allocated to the owners of the parent and NCI in proportion to their ownership interest, such as 180 to owner of the parent and 20 to the NCI. Now, in the context, we have 180 to the owner of the parent and 20 to the NCI. The allocation of the loss is not in proportion to the relative goodwill amount, like 475-25 or ratio. It will be always on the ownership proportion, ownership interest, proportion of their ownership interest in the full goodwill method. But in the partial goodwill method, it will be on the goodwill value. Now recognized goodwill is therefore 300. How? 500 minus 200. 200 we have impairment loss. After accounting for the impairment loss, impairment entry is DR retained earning 180, DR NCI to 20, NCR goodwill 200. Means goodwill will increase by 200, NCI will decrease by 20, and retained earnings will decrease by 180. So in the pre-populated sheet, we just need to type 180 minus 180 from the retained earnings, minus 20 from the NCI, plus 20 in the goodwill. Sorry, plus 200 in goodwill. Thank you for this video. In next video, we will study chapter 4.